Hello and welcome to a very special edition of Market Masters, where the brains trust of JPMorgan is joining us ahead of their India summit. My guests are Sajjid Chinoy, the Chief India Economist, Kaustubh Kulkarni, the Senior India Officer and Vice Chair, Asia Pac, and Sanjay Mookim, the Strategist and Head of Equity Research. I hope I got your designations right. Gentlemen, what a great day to have you in our studio at that. Sajjid, this is the unexpected first question, but it's just lit up all markets in India. The JPM bond index. I don't know if you all know the numbers better than the rest of the market. How much money are we really talking in terms of what can come because of passive funds?
Latha, given the amount of assets that track this index and given India's 10% weight, I think from this index, the direct flow will be somewhere in the range of $20 to $25 billion starting from next June over a 10-month period. And then, of course, there'll be some catalytic flows that amount because of this. But I think the larger issue is not so much about the quantum of money. It's about two other things. One is to just have some more heterogeneity in the investor space in the bond market. The more heterogeneity you have, the better price discovery you will have in both directions.
No, but passivity, I mean, you just have to be there.
That was my second point, that it's really passive flows. And I think bond money and debt money now has become, attracts a lot of indices. And so if India has a 10% weight, what you should expect is not too much volatility around that. In the good times, investors may take 10 to 12. If there are adverse shocks, they may go down to 8. So I think that's the part that we should recognize, that this is passive money that's here for the long term, and therefore is in a way India tapping into the global pool of savings to finance its current account deficit.
Oh, absolutely. We've had enough experts speaking to us, and the expectation is that once JPM index bites the bullet, as it were, the Bloomberg, Barclays, the FTSE Russell will all also include. So the numbers that are doing the rounds is probably 40 to 50 billion, only passive. And then there are, of course, actives who want to, take advantage. So, that question to you, Sanjay, how would you look at equity markets if there is this kind of money? Do you think now leveraged companies would be preferred because, it's going to be cheaper to borrow? Would you think banks become a little more attractive? I know you have not rewritten your strategy report, but what may be the likely changes?
Well, I think, and Sajjid will be better to comment on the currency and rates impact.
Yes,
but look, this will be to prima facie be supportive of the INR, so you would not be worried about terrible depreciation for at least the next foreseeable future. Will Indian bond yields go down too much? We'll see, I guess. But the argument logically, Latha, will be that a lower interest rate would be supportive of valuations of companies because your WACC in the DCF goes down and so on. My only nervousness is that we are not pricing off the 7.2 in the Indian equity market anyway, right? The equity market is already way ahead of all these inclusions in terms of using a lower cost of capital in its valuations for longer-term growth. I personally don't expect any decoupling of India's equities to the global equity sentiment. And that's a theme that we've been writing about for a while, that India's great in the long term, all this structural growth is real, but in the short term, the market does move in line with global sentiment. And that's why, a month ago, we wrote the note that the market still looks very toppish.
No, I take your point entirely on that, but immediately you would think that banks become more attractive. Mark-to-market gains.
Potentially. But I think the equity market tends to look through these mark-to-market gains. I mean, even when you have losses, you don't go and sell some of these stocks anyway. So, yes, there will be support to earnings accounting-wise, but I don't think that will be a fundamental reason. Banks anyway look great to us because earnings growth is strong, and it's probably the only sector in the market where valuations are acceptable. Yeah. So the core argument still is very strong.
Very strong for banks.
Yeah.
I'm just coming to you in a minute, Kaustubh, because we just want to get through with this big change that is on us. Sajjid, there will be a big inflow of funds starting from June. And according to bond market experts, even ahead of it, active funds may come in.
Right.
So, how should we approach the Indian rupee?
Yes.
On the one hand, there is the strength in the US dollar. The dollar index is at 105. And the US 10-year yield at 4.5. I mean, why would an exporter want to sell and come when he can get 4.5 for dollar? So, how should one approach the rupee?
Yes.
And will the RBI have now a big problem? They will not want a rupee appreciation because we may become uncompetitive.
Yes. Latha, we're at the 10th anniversary of the taper tantrum, right? What is the biggest lesson we learned over the last 10 years? Buffers matter. right? We had $280 billion of reserves then, almost $700 billion at the beginning of last year. I think the RBI strategy, in my view, should not change, which is that when you do have large balance of payment surpluses, you buy these buffers, you buy the dollars up, because these reserves are not earned reserves, they're borrowed reserves. There are corresponding liabilities in the economy which could exit the day after. So I think we have to think through the general equilibrium impact over here, that if these flows do come, I'd expect the central bank will buy those dollars, will not allow more than a small amount of appreciation. And there is also a corresponding impact on the bond market that we're not fully internalizing. Because when you do buy those dollars, you are generating rupee liquidity. And sterilizing that, which is what the RBI will want to do if you're worried about inflation risks, will entail the RBI selling bonds. So when you think about the net impact on the bond market, essentially foreigners will be buying bonds, but if the RBI is sterilizing those dollar purchases, that to some extent at least, these will be partially offset by the central bank selling bonds. So this is clearly positive from a medium-term passive global savings perspective, but the impact on prices, whether it's bond yields or the rupee, are a little bit more nuanced given the central bank's reaction function.
Do you expect an OMO sales this fiscal itself or in 2023 itself? Because I thought at this moment, if the dollar flow is big,
yes,
RBI will buy the dollars and they're very happy to tighten liquidity,
yes,
because that is anyway their position. You actually see them selling bonds.
I'm not saying this year. I'm saying that when these flows come over the next year, I think what the RBI has done very well is ensure that liquidity is consistent with their rate policy. If US rates are going to be high for long and Indian rates are going to remain at current levels, you won't want liquidity to run ahead of where yields are. Okay. So next year, if you do have a large BOP surplus because of this, it will be understandable why the central bank will want to sterilize these flows. Right. One way of sterilizing it, there are many ways to sterilize, is to sell bonds and soak up that rupee liquidity.
I guess they're more independent in selling bonds rather than selling dollars, because that will depend on global matters. But Kaustubh, you have to tell me, who's your audience in the summit? Are you seeing some last-minute rush of FII debt funds wanting to come in? More generally, who are the funds coming in? I also wanted to know if there are more India-dedicated funds and not just funds coming through GEM.
Okay, so I think the way we look at it, there are almost 400 investors attending your conference. I think it's almost 50% more than what we had in the previous year. Ooh. So that's the first sign. I think of those 400 investors, almost 300 on the equity side and about 100 on the debt side. We have about 75 companies, which represent almost about 1.2 trillion of the market cap in India. And I think from those 75 companies, there are a number of corporates and others who are also attending a number of sessions and high quality content we have planned. So we have 250 attendees from the corporate side who are coming in. So it's being done at a very substantially larger scale. We would like to welcome more, but I think ironically, we had to stop registrations because I think we just couldn't accommodate anything more.
So those who came after the
No, even before that, actually. Even before that. So we just run out of full capacity, given, I think, the response that we have received both from companies and from investors who really want to be a part of it. And I guess the reason
But you would agree that there is money coming not just through GEM funds, yes, but now more India dedicated, you would say?
I think not yet, because generally, if you're a large global pool, there is benefit in size. So if you're managing 10, 20, $30 billion of emerging market funds, it is easier for you and more flexible for the fund manager to allocate accordingly, rather than just doing an India dedicated. Having said that, there are clearly India dedicated funds which are being targeted and marketed globally. But the relative size of those is still sub 10 billion. Okay. And we are getting good representation from both sides of investors.
Okay. Sanjay, now to come, when all this money comes and this kind of interest is shown, do you think that Indian equities, I know you said that you're watchful of valuations, but will we trade at higher valuations than, say, the long-term 20-year average?
We already are there, Latha, unfortunately.
Okay.
And if we weren't...
But I thought we are still south of the 2007-2008 valuation.
Possibly. So if you exclude the extraordinary periods of valuations post-GFC and the COVID, then we are close to all-time highs on the Nifty already. So if we weren't, then you'd be a little bit more comfortable. But making an investment case saying that the multiple will go higher is always weaker an argument, right? You always want to buy the earnings growth and the compounding that the economy will generate, rather than to base your thesis on saying, I think other people will buy at higher multiples, right? Okay. So the first part, we are confident. You will get decent earnings growth, and actually we've written research that earnings growth in the next few years will be better than the pre-COVID period and so on. But is the thesis based on higher multiples? I wouldn't go down that path.
Let me come to one of the sub-segments that have done extremely well. Mid-cap PSU banks have done very well. And, we just tend to get carried away with the mid-cap PSU banks. Even the small-cap private sector banks, some of them have done very well. So you began by saying that anyway you are very happy with banks and, at the current juncture, they are on your buy list. Would you go down the queue?
Well, I'll take the opportunity to pat ourselves on the back because a few months ago, we write these tactical notes on what sectors look interesting for short-term trades. We did pick out PSU banks 4 months ago in one of our research pieces. And the thesis for that, Latha, was that we were starting to see, again for the smaller banks, earnings upgrades. And the sector, if you remember, around the first quarter had underperformed the market. So it was a great opportunity to look at sectors or stocks which hadn't done well for a variety of reasons, but were delivering earnings better than expectations and were driving upgrades. I think that's what's kicked in, where it's caught the market by surprise. I mean, we've seen banks do well for the last 2 years, but you had this another mini cycle which has lasted for a while. We do think that the overall loan growth will slow, right? And this is tying into the lack of liquidity in the system. Deposits are a constraint, and margins are coming in under pressure. So the sort of growth that you've got from banks in the last couple of years will slow. But if you look at a combination of growth versus value, the entire financial set is the only thing that makes sense in India, I mean, logically at the moment.
Okay. I'm not done with the sub-segments. There is the other two superb segments, not two, actually three. Railways, defense and power. And many of them are overwhelmingly public sector. So those questions to my experts after a very quick break.